Ladies and gentlemen,
Good evening.
Are you ready?
Okay, here we go.
You're listening to the Deal Room Podcast. Join us as we bring you the inside scoop on business sales and acquisitions. Get across trends in the area and hear the industry's best recount their real-life tips, traps, and experiences. Now, here's your host, Joanna Oakey.
Hi, it's Joanna Oakey here. Welcome back to the Deal Room Podcast, a podcast proudly brought to you by our commercial legal practice, Aspect Legal. Now, today we are back for part 2 of our 2-part series all about acquisitions for growth of a business. And so if you didn't listen to part 1 was all about why 77% of all acquisitions fail and how not to be one of them. But in this episode, part 2, we're trying to provide a more uplifting approach to this discussion. We're talking about how it is that you can be the 1 in 4 acquisitions that are a rip-roaring success. And in order to continue talking about this, we have the very, very knowledgeable Mark Johnston from Sherlaws Group to give his insights and case studies as to how acquisition through growth can fuel your organisation, but how to do it in a way that leads to a success rather than a failure. So buckle in for part 2 of our series. Here we go with Mark. Mark, I just want to say a massive thank you for coming back onto the Deal Room Podcast today for part 2 of our 2-part episode all about acquisitions for growth. Welcome back.
Thank you for having me.
Oh, my absolute pleasure. Now, I'm an optimist at heart, so I couldn't leave it at our part 1, why 3/4 of acquisitions fail. I felt we needed to round it off with this part 2, how to make it a roaring success.
A good news story.
A good news story. I like the good news stories. I just feel like maybe we've depressed all of our audience who are off for acquisitions by our last episode. Let's do the upbeat version and let's talk about what it is that businesses can do to make an acquisition a success and what it is that they should look for when they're acquiring.
Yeah, great. And thank you. Firstly, as we discussed in the first half, firstly, tap into why you're acquiring and really get clear as a business, as when you're looking at other businesses, as to what you're trying to achieve from that, why you're doing it, and then look for aligned values in that company as well. So if you get really clear on the why we're doing this and what it's going to achieve, we can then create that success. So often we talk when looking to acquire is we actually say, well, let's take off your management hat and your employee hat and put your shareholder hat on and actually say, well, ultimately we're acquiring a business to create share price growth. So let's look at how do we actually, one of the key contexts is this going to actually create the right amount of share price growth? And you get share price growth from having, managing risk and reward. So what we often talk about is what would you do if you had a blank whiteboard? What are the 3 rules that you'd apply?
Before we talk about those rules, I just want to stop just to highlight what you've just said, because you're talking about share price value here, which is something that maybe sounds obvious, but that component that I find business owners often just don't think about, that share price value, rather than just revenue profit, it's valuation, right? So anyway, so I just wanted to stop and highlight that, because I think therein is something that maybe is implied in what you're talking about, but it's such an important point. Okay, all right, so the 3 rules then.
Yeah, so the 3 rules of Silicon Valley, the first and most important one is what's happening in the industry. Is the industry growing? Because as we talked about in our last podcast, 98.4% of the returns come from the asset class you're in as opposed to an individual company. Just like the mining example, the worst miner is still going to get 6 times the share price growth because of the iron ore price. So the critical thing is to sit there and say, well, what industry are they in and what industry are we in? And if we're going to invest in an acquiring company, if we're going to acquire a business, let's make sure that there is growth in that industry. So the Maloney family built a very successful mining services business servicing the mining sector, and were able to sell out at an $800 million return purely because they'd picked a hyper-growth market. So if we're looking to acquire a company, firstly, we want to look at the company itself and make sure there are a whole bunch of things that are in that company that satisfy our due diligence processes. But most importantly, it needs to be in a growth industry, because if that industry is in decline, where it doesn't matter how well run the business is or how well run our approach is to the acquisition, ultimately we won't get the returns. So the golden rule is pick a growth industry, because that rising tide will lift all the boats and significantly de-risk the returns when you're deploying your capital. Because for most of us, when we're in the SME sector, we don't have tens of millions of dollars sitting in the bank. We've got a limited amount of capital, which we want to deploy wisely with as less risk as possible. So the first rule is to identify a growth industry.
Sorry, and can I pause there? Quick question. How is it that business owners who've never thought about this before, never thought about looking at different industries and growth trajectories and trends, are there some simple tips that you can suggest for them as to how they work out what their industry looks like in terms of, trends, growth?
Yeah, look, absolutely. And firstly is understanding, what business they're in themselves and what industry they're in. And, the oldest example is Union Pacific, were the largest company in the world in 1900. And they thought they were in railways because they built railways across the United States and piggybacked the growth of the United States. So they thought they were in railways. And a growth market happened right under their nose in 1904. Something called air travel was invented by the Wright brothers because they flew an airplane. And then in 1909, Henry Ford invented mass production of the Ford motor car. So they thought they were in railways. So they just looked at these other sectors and said, or these other businesses and said, well, they're doing their own thing. If they knew they were in transport, what they would have done is bought Ford Motor Company very cheaply and bought the Wright brothers. It's why Yahoo tried to buy Google for $3 million. So Google wanted $5 million from Yahoo. Yahoo offered them $3 million, and Google said no, and the rest is history. So when understanding, so what you look for are related industries. The newspaper industry is a really good one. It's in decline, and as a result, what that means is because they thought they were in printing, not content. And now we look back 20 years after the internet revolution and think, well, how could they not know they were in digital content? But 20 years ago, the management teams had grown up on the printers, et cetera, et cetera. Rupert Murdoch famously worked on the printing presses in 1948. So what we see in industries and businesses is a narrow blinkered approach of we're in widgets or we're in this. And if you're a hammer, everything's a nail. So what Union Pacific could have done is bought Ford Motor Company, just like Yahoo tried to buy Google for $3 million, and that's the most expensive $2 million, I think, in history, not going to $5 million. But another really relevant example is when Union Pacific were the largest company in the world, the people that cut down the trees and made their wooden sleepers, because the sleepers for railway tracks are made out of wood, as everyone probably knows on the call, that company was called South Pacific Rail Infrastructure Network, and they didn't think they were in the sleeper business. They knew they were in the infrastructure support business. They were providing infrastructure support to a high-growth industry such as Union Pacific, just like the Maloney family in mining services. So who Sprint is now today, 140 years later, South Pacific Rail Infrastructure Network is now a company called Sprint. It's the same company, and they provide cell phone tower and cell phone services to the US cell phone providers. So they've always been in infrastructure. They used to be called South Pacific Rail Infrastructure. They're now called Sprint, which is a much more fancy name, but it goes back to their origins. So understanding what business you're in and that growth sector. So the internet, growth industries like that, the green economy, if you look at the green economy, well, that's obviously an area where there's continued growth. So what to look for are growth sectors where there's demand driven by technological change, et cetera, et cetera. Not necessarily government change, but look for technological change.
And the point of all of this, I guess, our discussion here is that you've got to look broadly because you might have the blinkers on and not realise you do. And I guess that's where external advice can sometimes come in useful.
And look, it does. And that's where, advisory boards and governance boards are really important. They should be able to see around corners. So the other key thing to look for is, is it a product versus a business model business? So if you're looking at an acquisition target and it's in a growth industry, What you've got to look for, in that Union Pacific example is actually, do they understand what business they're in? And is it product-based or is it business model-based? Because if it's just product-based, product cycles change, technological advances happen, disruption occurs. We see it all the time. But if they've actually got a business model mindset and can adjust their product, just like South Pacific Rail Infrastructure Network did, what that means is the business is much more likely to, profit from the growth in the sector, but also, just as importantly, have less risk associated, because as soon as it's heavily focused on just the product, the product can go away. And the best example for all of that is printed newspapers. How many of us on the podcast, still, read a newspaper in print versus read it on our phones or on our iPads. And then the third most important thing to look for is the quality of the management team. And this is really important. So the first thing is the industry growing? Because that 98.4% comes from the asset class. Do they have a business model approach as opposed to a product approach? And then is the management team of high quality? Because ultimately, a quality management team, and Peter Drucker has done many reports on this, but culture trumps strategy every time. So what you want in that quality management team is the right sort of teamwork, no ego, humility, that ability to be resilient, to come through change. And that's what they call, in private equity and venture capital, because the advantage of taking a venture capital mindset is that venture capitalists are actually people who invest in a business to hope it's successful. So we need to take that mindset when we're looking to acquire a company. What would a venture capitalist think? How would they help this business be successful? What would they look for? And if we look at their investing rules, well, we can just apply that ourselves. And if those three are in play, well, the acquisition is much more likely to be successful. If one of those isn't in play, if the market isn't growing, if they don't have the right business model and they don't have the management team, it's much less likely that your acquisition will generate the returns it wants. So why they talk about, private equity and venture capitalists talk about putting the band back together, is what they're actually doing is putting a quality management team that they've worked with before, you've worked with before, back into the business. The private equity guys do it all the time in turnarounds. They bring their own guys in. So, for our listeners on the podcast today, if you just think about in your corporate work experience or your current world, like people you really enjoy working with, or really quality teams that you've worked with versus poor teams that you've either worked with or a boss you've had. Just think about that. Just think about if that poor boss, the worst boss you've ever had, if that person's in that leadership team of the company you're acquiring, you're not going to get the results. Whereas if the best ever leadership team or management team you've ever worked in, if they were running that business, what could they do with that? So quality management team is absolutely critical.
All right, so they're the three key lessons from Silicon Valley. So now let's maybe move on to what it is that businesses should look for when they're acquiring.
So what we kind of call those first three factors are the macro factors, like they're the most important things. And the next things are what we call the micros, which is, again, just as important, but almost subsets of those first three criteria. So the first thing to look for, when acquiring is what we call the logbooks for a car. So if, when we're looking to acquire a business, we often don't take the mindset we do when we look to buy a house, because what we do when we buy a house, we get an inspection report, we look for the opportunities, can I create growth, add a room? And it's the same with a car. So often, we see businesses where in Silicon Valley, they call it, they've painted lipstick on a pig, which is the business has just got a paint job. It's like buying a house that's just had a paint job. So if there are two classic Ferraris for sale, both for $200,000, and one is owned by a gentleman of indeterminate wealth where you're not sure where it came from, and the other is owned by the president of the Ferrari club with logbooks, service history, all the way back through the last 30 years. Well, if both of those cars are on the market for $200,000, what we find when we do our public speaking is people won't buy the guy, the Italian gentleman from Carlton in Melbourne. They won't buy his car for 190. They won't buy it for 180. They won't buy it for 170. They'll buy it for about 150, because at that point there's the risk reward kicks in. So what we talk about is, if you don't have logbooks in your business and talk about how you adjusted with failure and have that depth of management reporting, what you're leaving is 25% on the table. So as an acquirer, what you want with that logbooks or the inspection report is it shows that the business has been well run.
And what are we looking for in these logbooks? So let's break it down.
Yeah, so what we're looking for are org charts, functional charts, how they grow the business, source-based KPIs. So outcome-based KPIs are, if you hit $1 million, we'll give you a $100,000 bonus. Whereas an activity-based or a source-based KPI is to hit that $1 million, you need to do 80 cups of coffee a month, which is 1,000 a year. And on January 31, when you started the year, if you haven't done 80, you've only done 40. There's performance management, etc. So what source-based KPIs or activity-based KPIs is they give you certainty. So we're looking for org charts, functional charts. We're looking for board minutes, like monthly board meetings. We're looking for action items that have actually been acted upon. So quite often when we go into the data room of a business, we'll see a bunch of information that was never acted upon. We'll actually look at the action items from the board meeting, if there was a board meeting. A lot of SMEs don't even have proper board meetings.
Yeah.
And we'll actually look at, did they actually do what they said they would do in the board meeting? And the next board meeting, 3 months' time, did they discuss that? And if they haven't, well, we know it's just nice to haves, but they're not actually running the business properly with governance.
Yeah.
The other thing we look for is when's the data room populated. So a really good trick for any due diligence or anyone looking to acquire a company is look at when the documents were saved. Because most people know that they need this information. So what we love to see is a data room populated quickly in advance. So if we give them a deadline of midnight on Wednesday the 15th, we actually like to see it populated a week before with documents that are 3 years old.
Yeah.
Board meeting from 2014.
Because they're organised, they've got it at their tips.
Whereas if it's if all the documents are saved, 11:59 p.m., a document purportedly from 3 years ago was saved yesterday or last night, that just is a massive red flag that you're going to get the results. So actually, and it's just like, it's like buying a house or an asset, right? The less risk in that asset or the house, that's why we have inspection reports, the more valuable it is, because when acquiring a business, it's not just about upside, but it's about managing that risk. So, we look for logbooks.
Yep.
They have those logbooks.
Logbooks.
And then the second one is management team quality. So how have they dealt with failure? Is there resilience? So what we look for in the data room, as we discussed quickly on our last podcast, was what failures have they dealt with and how did they deal with it? Because what we want to see is a ratio of about 80% success, but also, the odd failure along the way, and they dealt with it, they pivoted, they evolved. Because if they've said that they've never had a mistake, they're either lucky or lying, and both are uninvestable.
Yeah.
and this is a critical one.
That's
If they say we've never made a mistake, well, there's ego in the business, or they're lying, or they're lucky. So if there's ego or they're lucky or lying, that's a red flag to walk away. And the other critical thing to look for is, as I said, do they have a governance board? Who's on that governance board, but also an advisory board as well. And advisory boards are very common in the United States and are becoming more common in Australia. And there's certainly something we recommend. And what we look for on an advisory board is typically it's got 4 people, and there's someone in your industry who's done what you're trying to do, which is what we call the grey head credibility. So if you're in construction and you're a $50 million construction firm, what you'd want is someone on your advisory board who's worked at Lend-Lease or built or something, who's done what you're trying to do. Someone else who can open channels or open doors that you couldn't open yourself organically. So that's often what used to be referred to as the Rolodex, that ability to open up doors and reward that person because it creates future growth. So what that means as an investor when we're looking to acquire is they've actually got some future growth in the business. I'm not just buying the business today as it stands. There is growth baked into it via these sorts of opportunities.
And that's the point of the acquisition, that there's growth in it, right? Because otherwise, why are you doing it?
If it's just what we call a linear growth, which is just last year plus 10%, plus 10%, 10%, you're better off putting your money in the stock market.
Yeah.
What we want to look for is that 30% growth minimum to compensate for the risk of an SME, but also otherwise you could actually do it organically yourself. So we absolutely, and the other person we want on the advisory board is someone who's got financial and legal knowledge to help SMEs, because that's often a gap. Often SMEs have grown up with the lawyer that first started advising them, who's cost-based and the accountant who first started advising them who's cost-based and not strategic. So one of the questions we ask is, how long have you had your accountant? How long have you had your lawyer? And if they haven't changed them up, or they haven't, or their lawyer or accountant hasn't grown with them, that tells us that they're probably not getting high-level advice. So what we'd love to see is they've got an accounting firm that's very strategic in nature, that's pushing the CEO to do the right sort of management reports. A lawyer they ring up before they incorporate a company or before they do something, as opposed to doing it and then going, oh, we might have made a mistake. How do we waste time and energy to fix this?
Fix it,
as opposed to, so actually, what's the skill sets they're getting? And then what we call a maverick on the advisory board, someone who's actually scaled a business in another industry.
I love it, maverick.
And we give it that frame. We give it that name. I don't think we have to pay copyright to Tom Cruise. I'm sure we don't. But that maverick often asks the question that golden question. They go against the grain. It's that angel's advocate. It's not devil's advocate. They're an angel's advocate. So if they've got that advisory board and that governance board, they're a massive tick. That's a massive green flag. It should give you the confidence. The other key thing is timing. So as we've talked about in the first podcast, when you're looking at your returns and your modelling, just double the time it's going to take and halve the upside to make sure you've got enough wiggle room. Because if the returns are dependent upon actually hitting the agreed numbers, you won't hit them. And then the other key thing is buy or build, which is what we call the arbitrage growth, which is, by buying them, does that save you the build time? So often companies will get acquired because a large corporate, buys the team. So also look for what can create that arbitrage growth so that you can actually get that compound growth from them by buying them to get that return.
And sorry, that's one of my favourite components of acquisitions, and that's where I see it used really well.
Yeah, speed to market is absolutely a great way to do it. And again, the typical two ways are they've got a distribution channel you don't have. They own a channel, or they've got a product that you could put down your channel and create hyper growth. And it might take you 18 months to build the product. You're better off paying a premium for someone who's got that product because you can put it down your channel immediately. So that speed to market context is what we call sort of arbitrage growth, or buy or build. And it makes sense for all parties. It makes sense for the acquirer. It makes sense for the acquisition. And the last thing to think about when looking at is, how do you structure the deal? So often when there's an acquisition, we see 51-49 on the share register, 51% to the acquiring company, 49 earn-ins, earns-outs, all these sorts of things. What that 51 is trying to what it's trying to solve is control. So what we do when looking at a deal is actually separate out the three components, which is what are the income or the revenue components of each deal for the company we're acquiring, and the revenue impacts for us of that acquisition. And that's where we look for hypergrowth. And then what's the equity structure? Because the reason, as we said, 51-49 exists is because we need to get that control. So, but often, if I could invest in a high growth property company and get 10% equity but want control, well, I'm never going to be able to do the deal. I know there's going to be growth. So what we often say is equity is about fairness and upside. And the mistake with 51 and 49 is it's about control. So the equity structure might be, to come in at 40% now and then 20%, buying it over time. What that allows you to do by getting the equity structure right is actually doing what's in both parties' best interests. Because as soon as it's one party's best interest and not another, that's where we get the failure rates. Because you've just got human beings that don't feel respected. So why we talk about separating out control is because if you separate out control, it can allow you to do a clean equity deal. So things like, power of veto or right of first refusal or those sorts of things for a defined period, typically 3 years after acquisition, or those sorts of things, tends to solve the problems, because most entrepreneurs, both from the acquirer but also the target acquisition company, we're all entrepreneurs and we're really happy to have revenue share conversations and equity conversations, and we'll merge this together. We'll go into a new co and we'll bring 60 and 40, and that'll, if my share price is $1 and yours is $1 and we can both get it to $3 by merging and the deal's 60-40, well, we do that every day of the week. What stops it is control and emotions. So by actually separating out the control, and this is really important for, if someone ever, has an internal staff succession, like it's always control. That's the issue and the sticking point. So actually separating out control processes around rights of first refusal, power of veto, 3 years, et cetera, and articulating those up front and putting those into the agreement means you can also, most importantly, initiate the transaction or complete the transaction much faster, which means it doesn't get into the opportunity cost, because as soon as we're arguing over things, that means the acquiring company's burning time and energy, and the acquisition target is also doing that. And
both, that's right.
And most importantly, if they're not, if they're spending 10 days a month over 9 months, not focusing on their core underlying business, but actually trying to manage a transaction, well, that's a significant amount of, of energy that distracted and a significant diminution in value, which is, one of the major complaints acquisition targets have. They go into exclusive negotiating periods and all these sorts of things, and they burn just a heap of time. So by actually articulating control separately and having separate agreements around that, it allows you to create the transaction much faster, which means everyone gets the uplift because everyone's focused in going the same way. And most importantly, where that control directly links back to is that linkage back to culture, and are they the right fit? Because it should feel right. I saw someone interviewed the other day, and they said they know they've done a good deal when both parties walk away unhappy. Because there's friction, and our approach is different. Like maybe a bit old-fashioned, but our definition of fairness, it's not necessarily 50-50, but a deal will work when both parties feel energized from it. Because if I'm going into a property with my brother 20-80, I put in 20%, he puts in 80, the returns on the profit or the capital gain should be separated out 20-80. If I've paid rent or done this, well then you have you keep a ledger, so to speak. So, but as soon as a party feels aggrieved or taken advantage of, they just don't work as hard. So what we want to create, if I've got a cake there, if I cut it, you get to choose which bit, right? It's the only way to guarantee fairness. If I cut a smaller bit, you'll take the bigger one. So that mindset shift of let's not have an adversarial relationship or an approach. Let's actually have a good guys approach and go, if they both feel energized and we feel energized because the deal's fair, well, both parties will, for the next 3 years, will work hard. And we'll have a much greater likelihood of success. So that feeling should be we both feel good about this.
Yeah. But it's an interesting point, because there's some personality types who just can't help themselves. They never feel like they've got a good deal until they've driven it as hard as they can, and then some. And then they feel like, that's the only way they feel that they've achieved a good deal. So it is a mindset shift, isn't it?
Look, and this is supposed to be the good news story. Let's because those sorts. I think we've all dealt with narcissists and control freaks. In business, we all do. And I don't think we need to get into psychoanalysis, but certainly, why we talk about control up front as a part of that is because as soon as, if we're advising a company, if in the target company, if we see that control freak or those control issues or those ego issues, that's just a massive red flag for us. What we want to see is humble leaders with good staff retention and a well-running, a business is an ecosystem of humans. And, when we do buy-side DD, if we'll walk the factory floor or walk the trading room floor with the CEO. We don't just accept they've got good numbers and the staff love them and all those sorts of things, because no one ever fills out a survey monkey going, I hate my boss. But when we walk the factory floor or the trading room floor or if it's an accounting firm, the floor, and if the staff are coming up to that CEO and saying hi to each other, and the energy's there, because can't lie about energy. So if the energy there, we're like tick. If you're walking the factory floor or the floor, and the staff are diving around, turning around the other way, trying to avoid you, you can feel the energy, right? No one can, no one can lie. So if there's that negative energy in the business, well, that's a red flag again. Whereas if there's that positive energy, well, again, we know that we're buying a team and it's real, because, again, the spreadsheets and the IM and all the information don't say, we've got, lazy staff, high staff turnover, no one likes each other. It doesn't say that. Whereas, walking the floor, paying a visit to them, it tells you everything, right?
It does. And it's interesting that the negotiation process can sometimes act as the filter. And this is where I think businesses need to be careful about who they're using as their deal team as well, because sometimes the deal team can step in and create an atmosphere that really sets everything off on the wrong foot. And if it doesn't kill the deal, then it can create issues that will continue to come up in the deal. So I think this is where some of the importance is about the members of your deal team as well.
Yeah, and that's, so many, we've all got those terrible stories of, at the 11th hour, it just goes pear-shaped because someone, said something in a certain way that they shouldn't have done, and there's frustration and all those sorts of real emotions.
It goes of the advisors sometimes as well.
Absolutely.
It can be a real problem.
And again, often the target acquisition company get frustrated because they're like, you didn't set the expectations as a deal team that I would have to spend this much time, provide this much information. If you tell a target acquisition target that that it's going to cost them, or they're going to have to spend this amount of time, do these things, you have to deliver on that. As soon as you go above and beyond that, the literal term is, I've had it up to here with these guys. They just keep on asking for more information. I'm done. This isn't what I signed up for. I'm out. And it's all because, as you rightly said, Joanna, the deal team didn't manage the relationship, because ultimately you're managing two relationships, right? You're managing the company you're helping on the acquisition side, and then you should be treating the target acquisition company like a future client, or as you treat all your other clients, because
as a partner potentially, that's what they're going to be, right?
They are. Literally.
All right. Look, that was absolutely brilliant, Mark. I've just loved recording this 2-part series with you. Now tell us, if our listeners want to get in contact with you so they don't make some of the mistakes that we've just talked about today, how do they go about doing it?
Go to our website, www.shirlawsgroup.com. That's SHIRLAWSGROUP, or info@shirlawsgroup.com, which will our wonderful young lady Emma in our London office will then filter that back through to me. So
brilliant. I love it. And of course, if you missed that because you are running along the beach, which you're allowed to do right now, or in your commute to work, if you're back at your work, then just check out the show notes because we have the links all there. Mark, I just want to say a massive thank you.
I enjoyed it. Thanks.
Well, that's it for this episode of the Deal Room podcast, all about how to make your acquisition a success and beat the odds. Now, if you'd like more information about this topic, then just head over to our website at thedealroompodcast.com, where you'll be able to download a transcript of this podcast episode if you're someone who just loves to look at the transcript of a podcast episode rather than just listening to it. On that website, you'll also find details of how to contact the fabulous Mark Johnston at Shirlaws Group if you would like some assistance with the strategy of growth for your organisation and in working through the concept of how acquisitions could help fuel your business. There you'll also be able to find details of how to contact our legal eagles at Aspect Legal if you or your clients are looking at heading into an acquisition, or indeed if you're gearing up for exit. We've got a number of great services to help businesses both in acquisition mode and in exit mode. So don't hesitate to get in touch and organise a free initial consultation where we can give you an outline of how it is that we can work together with your business. Well, that's it. I hope if you missed part 1 of this 2-part episode, you go back and have a listen to it. It's a cracker, and talking all about why 3 out of 4 acquisitions fail. And as I said, hopefully you found this last episode a little bit more upbeat in where we talked about how to beat the odds. If you enjoyed what you heard today, then I'd absolutely love it if you could head over to Apple Podcasts or your favourite podcast player and leave us a review. But until next time, that's it. Thanks again for listening in. You've been listening to Joanna Oakey and the Deal Room podcast, a podcast proudly brought to you by our commercial legal practice, Aspect Legal. See you next time. Aspect Legal has a number of great services that help businesses prepare for a sale or acquisition, to help them prepare in advance and to get transaction ready. We've also got a range of services to help guide businesses through the sale and acquisitions process. We work with clients both big and small and have different types of services depending on size and complexity. We provide a free consultation to discuss your proposed sale or acquisition. So see our show notes on how to book a time to speak with us, or head over to our website at aspectlegal.com.au.
Ladies and gentlemen.
That will conclude this evening's entertainment.
Thanks for listening to the Deal Room Podcast. To find out more about this episode and other episodes in the series, check out the show notes or head over to our website at thedealroompodcast.com.au.